We do this periodically. It was like kind of like this first principles conversation. Like, wait a minute, let's talk about where we actually think we can win. And then that was a couple hour conversation, which we then tried to synthesize into the post that we put out.
Welcome to Triangle Tweener Talks, a weekly podcast by builders for builders where we explore the startup journey from the idea to the exit and all the lessons in between, with an exclusive focus on founders from the Triangle region of North Carolina. Now here's your host, serial founder and general partner of the Triangle Tweener Fund, Scott Wingo.
First, a huge thank you to our gold sponsors. Today we are featuring Robinson Bradshaw. With national reach and deep Triangle ties, Robinson Bradshaw delivers high-touch, sophisticated legal counsel to emerging growth companies and venture investors. We'd also like to recognize our silver sponsors. Today's Tweener Talk features Automated Consulting Group. From AI strategy to ROI in 90 days, Automated Consulting Group brings executive-level AI expertise to businesses without enterprise budgets. Thank you again to all of our sponsors for supporting Triangle Tweener Talks and the entire Triangle startup community. It takes an ecosystem to build a thriving community, and sponsors like these are very valuable, and they contribute their time and also help sponsor things like the Triangle Tweener Talks and Triangle Tweener Times. Thank you. Welcome to this episode of Tweener Talks. I'm your host, Scott Wingo, and on today's episode, we're going to dig deep into this topic, which is the SaaS apocalypse, SaaSageddon, the death of SaaS, whatever you want to call it. This topic is very topical because any public company, software as a service company, stocks are down very materially, hundreds of billions, if not trillions of dollars at this point. As the market assesses the risk that AI poses, this is flowing down into the private markets where we live. And we published a piece at Tweener Times called "The Tweener Founder Bat Phone is Ringing Off the Hook, SaaS Blood in the Water." That's linked to in the show notes for your reading pleasure. And then one of our favorite people in the ecosystem, or group of people, is Front Porch Ventures. You'll learn all about them on the pod, but one of their three rockers is Joe Mancini. He's kind of the voice of Front Porch, if you will. Excited to have him on the pod for the first time because they wrote a piece that was called "Yes, SaaS is Dead as We Know It." And in this conversation, we're going to talk about this topic. And as always, very, very oriented towards what you as founders and people in our ecosystem should be thinking about and doing as we go through this moment in time where there's a lot of disruption happening and a lot of kind of feels very chaotic and frantic right now. So hopefully this helps you navigate that, and really enjoyed this conversation with Joe. I hope you do as well. Welcome back to Tweener Talks. My guest this episode is Joe Mancini. He is general partner of Front Porch Ventures. Joe, good to see you.
You too, Scott. Thanks for having us.
Yeah, I forget the name of that thing that ranks your background, but you got a good one. You got the plant, you've got the picture, you've got some lighting. Very, very beautiful background.
I don't know what kind of score I would get. I got Rosie the guard dog back there. So
okay, all right. And then you live in the Triangle area, right? Or is that where you are today?
We live in Cary. Offices in Durham, and we're either here or on a plane somewhere. But we're here.
Appreciate you coming on. One of the reasons I reached out to you is we published a piece on Tweener Times that was called "The Tweener Founder Bat Phone is Ringing Off the Hook. There's SaaS Blood in the Water." And then I think almost the same day or right after, and I know you didn't look at what we were doing, but we were both kind of reading the same tea leaves, I think. And you published a piece as well, and yours was "Yes, SaaS is Dead as We Know It." And I wanted to get you to come on and talk about that. Before we do, let's back up a step and talk to folks about your background. Now, Nicken has been on the channel before, if you recall. So last year, I think it's been almost exactly a year, he came on. Nicken is one of your three partners. And I know you know that, but for folks that don't. He did Tweener Madness for us, which was awesome. We really appreciate him doing that. And but for folks that may have missed that one, give us the Mancini background, and then also what the heck does a Front Porch Ventures do other than help people restore their front porches?
A little more than that, and I'm not even sure we would be good at that part. But that's a whole nother story. My quick background. I mean, the guys always cringe when I start with this, but my first job was sports talk radio. other than cutting grass and doing stuff like that. So I appreciate you having me again behind a mic.
That's good. It gives you the gift of the gab. Like that's as a tech founder, I've had to like really like develop that skill. Like just be able to talk is hard.
I mean, I think I look back on it, super thankful that very few people listened to this show. I mean, it was drive time, but it was AM radio, right? News radio, 1070 WINA. And like, it was, we did like a little bit, you would record it on like a cassette tape for a podcast, but it wasn't like this where you could go back and listen to yourself all the time. So thankfully I don't have to go back and do that. I'm sure nobody wants to do that. But anyway, yeah. So first time was Sports Talk Radio, late night at a radio board, kind of had a moment where I was like, I don't think I want to do this forever. What do you do when you don't know what to do? Either consulting or law school. I jumped over to consulting, and then kind of more relevant to some of the work that we've been doing today, as well as the piece that we put out, kind of rode the wave of mobile for a while, deploying mobile networks and working in and around the mobile app space. Rode the Salesforce and the cloud wave for a while. Middle of that era, met actually Greg and Nick in grad school, so we've known each other a good long time. That's kind of a separate story.
At Duke, right? Duke MBAs. Is that where y'all went?
Yeah. We all met at grad school. It's funny. We started off as close friends, and then the more work we did together, the more we enjoyed that we realized we really enjoyed working together. And grateful for the chance to do that day to day now. But that was 15 years ago. At this point, almost 20. And so I kind of rode both of those waves. I ended up shifting from consulting over to more operating roles at Google in an era where Google was, really trying to figure out, it's kind of reminiscent of today, like how do we get the innovation engine of the company back started, right? We were behind on mobile. We felt like, the country needed more broadband. So a lot of my time in that era was spent at Google Fiber, on the kind of CapEx side of deploying and pushing the broadband, picture forward.
Doesn't get more operational than Google Fiber.
Not more operational. And it's funny. It was like the third act, or maybe the fourth act of, the connectivity, cycle, right? Where we'd put a bunch of fiber out in the world, then we did mobile for a while, then we kind of doubled back to fiber. And I think these days, with as much as we're all using it, we're happy we did. And then last kind of operating role was a company called Digital Turbine, which was kind of the present day version of a Durham startup darling called Appia, which was in the app economy and just a marketplace for mobile apps to get distribution onto cell phones.
Good old Jed Bowman. He's been on the show. We've had a good interview with him.
Great interview with him, and we could write a book about that whole journey. But anyway, so then, in the meantime, had, been in touch with Nick and Greg, and we'd done some investing together and started to have a flywheel that spun, a little faster than we probably initially expected, in a hybrid model that backs both venture capital funds as well as invest directly into companies. And firm started with a focus on the Southeast, and we've yet to find any reason to go anywhere else. So capital is concentrated DC to Miami and west to Texas at this point.
Yeah. So help folks understand that. Let's peel that a little bit. Like, so that means what when you say hybrid?
Yeah. So about half the capital we invest in other venture funds as an LP. Pretty diversified group of specialists. So we'll back groups that are deep into tech and software, deep tech, healthcare. These are the types of funds that send you 50-page newsletters on like their specialty, and they're just so deep in what they do. And we just love learning and being partners to those funds. More often than not, the rounds that they're leading, and we typically invest in lead investors, need a second or a third check at the seed, or sometimes the Series A, and it's helpful for that check to be complementary and collaborative. And we then invest about half our capital with that setup, alongside either funds we've invested in or funds that we've just become friendly with, to try to get rounds done and get founders, out of the fundraising game, which is, as we all know, just takes an inordinate amount of time, and, back into building.
So you guys just announced something about Fund 3. Tell us what that was, and congrats on, it's very hard to raise capital right now. So congrats on that.
Yeah, as always, we can't talk too much about it, but we've passed the starting gate for Fund 3. We're out. We'd raced to the starting gate, and now we're racing out the gate from there. And we'll continue a pace with 8 or, maybe upwards of 12 fund commitments this year and 8 to 12 direct investments. To date, we've backed 25 firms and 53 startups.
It's tiny compared to us, but a lot for other firms.
Yeah. You guys have a long. I mean, the tweener list and the tweener checks. Start to register on PitchBook. You're doing something. So
you write bigger checks though. So we're the king of lots of small checks.
Yeah, it's been great. I mean, I think there's no lack of folks who can, advocate for the benefit of all the work that y'all have been doing.
Yeah. Same for you guys. Do you guys take board seats when you do that? And I know as we record this, it occurred to me, millions of founders are going to say, "Whoa, they write checks. How do I meet this Joe Mancini guy? I know he lives in Cary. Let me drive around Cary looking for him." Don't do that. But do you guys, if folks are interested in pitching you, do you guys have like a forum or a process that folks can kind of go to on your site to start that process?
Yeah, form on the website, frontporchvp.com. All of our LinkedIns are very open, right? So feel free to reach out that way, and we can get some time. And we try to work with founders in a few different ways. And the most obvious way is we do kind of check. Sometimes we also will just sit and help folks, given the data we sit on, just understand a little bit of the fundraising landscape. And, our opinions that venture is like way too mystical a space. And if we can help demystify it through, talking about terms and what we see at, market and, the stories that we feel like are getting funded right now, we're always happy to sit with folks.
And I'll put a plug in. You guys, speaking of data, a great way to follow this is following either the Front Porch LinkedIn or you or Nicken or Greg, and then George, and then but you put out a newsletter. How do people? I forget the name of it.
Yeah, we got 2 versions of it, right? Which always evolving. So we do a kind of a quarterly out to email, so folks can just be in touch and give us their email address if they want that. That gives a lot more detail around the investments that we've done, and then where we had published the yes, SaaS is dead, but didn't we already know this post was on Substack. We have a Substack called Three Rockers, and Three Rockers is just, and maybe to the genesis of the post. I mean, I always reminded folks, like, I'm but the translation layer, right? So there's always interesting conversations that happen. We think they're interesting between us and investors, between us and other funds, us and founders, and every once in a while we feel like we have had enough of a substantive conversation that we want to summarize it a bit. And, we do that on Substack when we've got something.
What's the origin of the Front Porch name?
I would say the original origin is that we had done a lot of work together on a front porch. But we had come, this is, kind of years and years ago, we'd come to really love what we hope it, the message it sends out to the folks that we're working with, which is that we want to be the type of firm that you could sit on a front porch with and, have a good conversation with, and do business in the way that we'd like to do it, which is, super collaborative and complimentary and, optimistic about chasing the future, not sharp elbowed.
It's very Southern. You guys are just hanging out there, having a little lemonade, and people come up and have a little chat about what's going on in the venture world.
Sometimes it feels like running around, but yeah.
Hanging out with the Three Rockers.
Exactly.
I've always wanted to do like a something about off your rocker thing. That'll come up.
I feel that.
So what was the impetus? Because you guys are out there talking to, you got 53 portfolio companies. You're not on the board, but you talk to them all the time, and you're in an ungodly number of other firms. So you're getting like all this data point coming at you. What was the impetus for writing this piece? Was it more what you saw in the public markets? Was it, we had founders just like hammering us, kind of asking us if they're going to be more efficient to just kind of put it out there. But what kind of drove you guys to think about this topic?
Yeah, it's funny. We had done a post in December that, probably the most common question we've been asked over the last 18 or 24 months is, how are you guys thinking about AI? Right? It's not even about the South or the Southeast anymore. People, I think are starting to understand that story more, but have just been really keen on massive technological change. And, how are you guys thinking about where what is a good fit for you to deploy capital versus not. We tried to, that was on the back of an email actually from an LP of ours who had said that they, were effectively like super concerned as to what was going on and wanted to wait and see some of the, dust settling on some things. And we're kind of keen to get our opinion on them. We then kind of hit the new year and watched it just like everybody else, kind of this like steady and sometimes, pretty dramatic drawdown in public, tech and software stocks and primarily SaaS, oriented stocks. And, and then had just we were all sitting together debating an investment.
Were you on a porch somewhere?
Yeah. It was kind of this like, and we do this periodically. It was like kind of like this like first principles conversation of like, wait a minute, like let's talk about where we actually think we can win. And then that was a couple hour conversation, which we then tried to synthesize into the post that we put out.
But before we go into that, one of the things on the AI topic, one thing we're seeing in our portfolio is a cohort of companies that are wildly AI native, and they're just like growing incredibly fast. We don't have like that cursor outlier, and certainly not a ChatGPT or something like that. Maybe Prion, the local company, is kind of on that trajectory. I don't actually know, but are you guys? And what it's leading to is they're raising money really fast. They kind of like go for a long time and don't raise money, and then when they do, it's big, and then it's kind of done. So we're actually seeing this whole weird thing change in the venture landscape, where the A's, the B's are becoming A's, the A's are becoming seed, and the seed is becoming pre-seed, because everyone's kind of starting to realize they're going to miss these takeoff trajectories if they don't go a little bit earlier. Are you guys seeing that? Is that just something we've seen in a couple of things, or are you seeing that broadly in your larger scope?
Yeah, it's interesting. I mean, I think certainly in the software businesses that we backed, we see that, right? And, see folks, effectively skipping their seed. We're excited for those. It's they're interesting conversations of when you actually go out for another burst of priced equity, right? Which is kind of a separate conversation, but we have a lot of interesting conversations there. But we have some things that are just, off the charts, which is great. Deep tech world is a little different because we do some deep tech investing. That's chunky, right? I mean, you hit a milestone, you get a big contract, you kind of have some breakout moment with a robotics business from a manufacturing perspective, and all of a sudden you start to add kind of, chunky but pretty durable revenues, sometimes recurring, sometimes not. And then healthcare kind of runs the range. We have software businesses that have really strong growth trajectories, not quite as strong as some of the other things that we see, just given, the buyers that they're selling into, but still, super high growth. And then we do some med tech things that are a little more kind of chunky and milestone based. In terms of the industry, I mean, it's been interesting for us to watch our seed stage partners on the fund side break into kind of two camps. And we've seen folks, to your point, some groups going earlier and basically saying they're going to cut a little bit of a smaller check than usual, but do it earlier at a smaller valuation, more likely accepting of it being on a safe, adding a little bit of a board construct, but not as much of a board construct as would be present in a price seed round historically, right? And kind of basically trying to do that to get in early because they feel like they've got a signal around the business or the founder that they can act on. And then we have others who basically said, no, we're going to wait, right? Because these businesses are hitting $1 million in ARR faster than ever. So we're going to be the group that is going to wait for that, make sure that we have a lot of customer eval that we can digest and assess. And then we're actually okay paying up at that moment and cutting a little bit of a bigger check. But the old seed is basically like, we just see it totally, it's into two camps now.
Yeah, split. Yeah.
And it's just entirely split. And all the old lingo is out the door.
Yeah, we're pitching for refi buy right now, and I found the definitions are all, they don't really matter because it's really, everyone like thinks about, well, if we do this size check. So everyone's thinking kind of like the check size, and it's people seem to care less about the name, which is interesting. Used to be like the other way.
Yeah, and I think part of it's that everybody's had 4, 5, 6 years of like the seed plus, the Series A1, the Series A2, the Series A3. And then so that's kind of one factor at play. And then the other is just that so many companies are just starting to skip rounds. And the old patterns have just, are we think just really out the door.
Let's go back to the piece. You guys were sitting there having a discussion, and you kind of had to back up and say, all right, what do we believe right now? So, and that's what you have in the article. So walk us through kind of the core thesis of where you guys landed on that.
Yeah, I'll kind of walk through the different kind of segments of it. And it's, it's on Substack for anybody who wants to get a cup of coffee and reading glasses and,
It's a good read. I recommend it. No, that's good. If you're building in this space, you got to read this stuff. Like it's my opinion. You got to understand the foundation you're building your company on, or else you won't be able to navigate all the things happening.
And it's, there's no lack of, and I similarly before I hit it, just encourage folks to just stay active. And, the piece that y'all put out, I thought was great. David Shainer's got one around generalist and specialist that I thought it was on Medium, but I thought was really good around kind of internal to companies, how he sees the next couple of years coming out. There's a lot of really interesting perspectives being put out that I think are, it's just worth the time to read them. Ours was basically hey, the public market conversation is just math, right? If revenue is less durable and margins uncertain, this is what you're going to see, right? And, not to, oversimplify it, but, that's, what we felt like we were seeing. And this is cause for alarm unless and if, like we do, you believe there's just a massive transformation in the way that, software businesses are going to get built, how they're going to get funded over the next, decade with AI in founders' pockets. And, kind of that was the first part.
On that part, do you think this is like a permanent re-rating of these things? The one way to look at this is to basically say these types of growers, these 20% growers, we're getting, I don't know what the number is, but let's say it's 8x and now it's 4x. Do you think it's just suddenly a re-rating as the market kind of has reevaluated and say, wait a minute, we just don't think this is as durable or generating? I think a lot of it comes out of the free cash flow calculations that people are now kind of realizing that if this is going to be a persistent decaying growth of 20%, churn's going to tick up. They're changing their FCF models.
Yeah. I'm not a public market analyst, but Greg could wax poetically on this for a long time. I mean, he would say it's you have kind of the shoot first mentality, right? Everybody goes down to some drawdown multiple, and then there's just deep analysis over a couple of quarters to figure out who's actually, bucking the assumptions that had been made in that drawdown. So I think we'll see some folks start to kind of find their way back up, and then some folks kind of flat to down. And, a lot of that is, it kind of depends on how quickly all of the margin pressure and to a degree in some of these behemoths, the revenue pressure actually starts to, show its way into, publicly reported financials.
Yeah. I think one of the big things, I was talking to a founder and he, we got this discussion where I think the private markets will do the same. They'll kind of throw out the baby with the bathwater, and then they'll start to figure out who, and I think they're going to look at churn really closely because the concern is there someone vibe coding what you do, right? And it's really hard to prove that that's not happening. It's like one of those proving a negative kind of things if you're a founder. And I was the only way I can tell another founder how to prove that is to really track churn meticulously and have a category that's kind of honestly that, they DIY'd it or whatever you want to call it. I wouldn't call it vibe coding. And, then present to a potential investor, here's our churn. Here's what it's been historically. Look, it hasn't changed. And here's the codes. And, you can see the number one, if you're selling to SMBs, the number one reason you have churn is the business decided to not be an ongoing concern. And, that's not an AI thing. That's just a structural thing of selling to that ICP. So,
yeah, and I just to that point, throughout this, we just believe that the eval is the moat, meaning that whatever your customers and users say about the value they're getting from using what you've put in front of them compared to the price they're paying for it, is ultimately going to, be the deciding factor here.
Perceived value. Yeah,
exactly. And that's always been true. It's ever true now. And for us, it's and this is just back to my operating world. There's kind of two groups of people in a company of any size. There's the people who serve customers, and there's the people who serve the people who serve customers, right? And the people who serve customers are increasingly being kind of replaced or augmented by AI. The most important people right now are the people actually in front of a customer or a prospect, hearing what they're saying, acting on it, and trying to build something, just a durable moat around offering something that's really purpose built to the requirements that they have.
Yeah. Got it.
But
I interrupted you. Keep going on the.
no,
thesis.
I get excited. It's fun talking about this stuff. So, so kind of we want to step way back. Let's look at other cycles like this, because on one hand, we want to realize that this is not like anything else we've seen before. I think that's true, but it's also true that there are patterns. When I say this, I mean this AI era that we're in. At the same time, there are patterns from history and prior cycles that we want to keep in mind while we're trying to figure out what to do and how to invest in this era, right? And kind of we broke it down into, every other cycle from electricity onward has had kind of, 3 layers that emerge: a system and an infrastructure layer, a utility and a tools layer, and then an application layer, right? And they've had different, forms, factors, and names over time, but that has been true it was true with electricity, it was true with connectivity, it was true with, the World Wide Web, data, cloud, mobile, onward, right? It'll be true here too. And we're in this period of time where like the units of expansion in and around AI, we're like still storming and norming, and every other day there's something new, right? I mean, OpenClaw had just as soon gotten all of us excited and buying Mac Minis that it now is a part of OpenAI, right? In like less than 2 weeks, right? It was renamed twice, and Lord knows what Sam Altman paid to hire that guy. And
it was more than $100,000.
I was going to say it was. I'm sure it had plenty of zeros attached to it. But that over time you start to see these like units of expansion normalize, standards emerge, and just like we saw with HTML, HTTP, just like we saw with apps and app stores and SDKs in kind of the mobile cycle, right? We're going to see some kind of standard set of units of expansion emerge, and like it's kind of like this buckle up era of trying to stay up with every little bit of news that emerges until the standards and kind of the best of the best start to differentiate themselves. Then we kind of broke apart all of the user kind of system utility and user application layer stuff for the AI era. And then probably most importantly, we just broke down, all right, let's look at digital maturity and size of TAM, and just put a bunch of industries into this kind of 2x2. And our belief is that there are much smaller industries that are yet to truly digitize, that with AI in a founder's pocket have a chance to digitize, because the cost of building software is just materially declined. And secondarily, there are heavily operational businesses, airlines, automotive manufacturing, chemicals. We have a whole list of them, right? That had yet to adopt technology in the way that many other industries had. But as the costs come down, to actually build something that's purpose built for their use case, there's going to be many more opportunities that we see, kind of in the smaller, way less digitized portion of that 2x2.
Is there one in there that you find particularly interesting or attractive that, man, I wish we could find a startup in this segment?
It's just, we've had a lot of, like the bottom of the 2x2 are like, we call them fragmented real world niches, right? So this would be like small TAM in the grand scheme of things, right? It's not real estate, it's not advertising. These are smaller things, waste management, government, local services, pet care, landscaping, et cetera, right? They tend to be fragmented. They tend to operate to a degree locally or regionally, right? And we've had a lot of success actually in that space. And I think one of the reasons we've had success is that a lot of the bigger guys, meaning the bigger software players, won't really touch that segment of the market because
it's too small.
It's too small. It's too fragmented. It's too different. It's hard to serve. We have a lot of startups in the portfolio now that are jumping off the page serving that segment of the market right now, which I think has been super interesting. Yeah, I mean, I'm really keen on the operational beasts. We call the bottom right operational beasts. So these are big markets, right, but less digitized. And we find that super interesting as you start to see autonomy play out in the robotics world and in other places other than AI. But together with AI, are there opportunities there? And I think there will be, and we're keen to continue to find them. And a lot of our deep tech investing is focused there: defense, dual use, things like that have a little more of a real world and a hardware application, but yet are also going to see some of the benefit of AI, generated software.
Does this mean, so based on what you're seeing, will you guys be changing like your focus areas, or you basically kind of came to the conclusion that, okay, we're okay because we're already kind of in these things, and now we feel like going back to first principles, the areas we're in are somewhat immune to this AI?
Yeah, I don't know about immune or not. I mean, I feel like that's like, with the news changing every like 3 days, I feel like it's hard to predict. We've always said that we would leave. The genesis for this conversation is we were debating an investment into something that was very horizontal, right? Meaning it was serving like a function in whole without a discrete vertical or an end market that it was going to be built for. And where we landed on it, as we've landed on others like it, is that we will leave those investments to much deeper pocketed investors in New York and the Bay Area, right? Not because we don't think that they're interesting, but we think they're more likely to find success with much bigger firms.
This helps founders because founders don't understand this sometimes, because the way the investor thinks about it, and I didn't understand it until I was kind of spent more time talking to these investors on the fund side. The way they think about it, and I'm not putting words in your mouth, but is, we want to support this company, can we, right? Because if it's a horizontal, they may have to try 4 verticals. Like I had Tony from Phononicon, they tried 4 verticals until they kind of found the one, right? And, that took a lot of capital to kind of burn through and get there. And as a smaller fund, you don't want to be setting yourself up for a future position where you can't support the entrepreneur. And you basically say, sorry, we're maxed out with you. Go find someone else to support you, kind of thing. So
yeah, I think it's just, there's an aspect of this game of like being realistic about where you are, who you are, where you're playing, where do you have strengths? And we feel like our strength is, and our knitting has really been in deeply vertical software businesses where the founder has come from the vertical and they may not live there forever, right? But that they have a chance to build something really unique and purpose built for that, end market or, kind of sub market because they came from it. And then they may go to others over time, but that they've got a chance to get out the gate and, build something with a little bit of a moat around it early because they're building for a vertical that they know so well. And I think, we're going to see like the next era is just, the vertical SaaS, kind of an explosion in a really good way in vertical SaaS offerings and vertical software offerings. That's most of what we've done on the software side in terms of our direct investments.
Let's say a portfolio company comes to you guys and says, hey, we're like a 5 to 10 million, kind of like Series A-ish type SaaS business, and been around since before ChatGPT era. So not what we would call AI native. And they say, oh my gosh, guys, are we toast? Like, what's your advice to those types of companies, those types of founders, kind of based on what you guys are seeing?
It's interesting to me because we had something a few months ago that we put out, maybe it was a year, it's probably 18 months ago, talking about how, we used to talk about like digital natives and digital immigrants, right? And there's the societal conversation around like, hey, we have people who grew up in the digital age and are going to be, digital natives. And then we have people who need to learn how to live in it. Right. And I think we have the same with companies in the sense that we have some AI native companies that are being built now and have the last couple of years. And then we have some that are going to need to learn how to, emigrate and adopt in that era. So the first bit of advice and the first questions we ask is like, demonstrate that to us, right? In the sense of how are you building and getting efficiency with these AI tools in your pocket, right? And, we can look at product roadmaps and release cycles and, dig into some things there to try to figure out whether velocity is increasing. And then a lot of it's just trying to, kind of go elbow to elbow with the founding team and understand how they're getting their work done. Flags for us would be when we see, headcount going in a direction that that we're just not seeing in the market otherwise, right? Or release cycles that look like they're kind of perpetually delayed. But there are businesses in that category you're describing that are, immigrating into the AI era and succeeding. But my advice is just like, if you there's been plenty of posts around this, but it's just like the time to dig in and make sure that everybody's got Claude Code on their computer and they've got a terminal up and they're figuring out how to use it. And then you're not just like tinkering, but actually figuring out how to ingest it into your business is not just now, but 6 months ago.
Yeah, some of those companies, and to be like 5 or 10 million, you got 50 to 100 people. You sometimes have a little internal mutiny. So there's I hear a lot of stories where, yeah, this worked great, but I have these 3 developers that just refuse to use these things, and what do I do? And it is this really weird. I don't understand why someone would refuse to use a better tool. I guess there's theology reasons. A lot of it comes down to, and developers in particular. I was a developer for a long time. We're a group that'll argue over spaces versus nulls and stuff. So spaces and tabs, and nulls versus zero. so there's going to be a lot of this is a big one to have a group of people that digs in on. But I guess I don't really. I think that's actually a career limiting thing for those folks. I don't think they're going to kind of stay along for a long time if they don't get on board the train.
Well, and it's a challenge, and you live and know this better than anybody, right? I mean, to continue to make sure that your team has a growth mentality through every phase. And even when you feel like you're getting close to making it, you hit 10 million in ARR. Holy cow, we survived all these wild times. We have $10 million in revenue, right? But the growth mentality to then, ingest and adjust to whatever's coming at you next. I mean, that's what's fun about working in tech, right? And I think the best founders have a way of just making sure that they always have teams filled with those types of brains. And if you ever find anybody in your team who's kind of resistant to these things, it's, you're getting a signal and you should act on it.
In your piece, you talk a little bit about some of the different pricing models you guys are seeing. Unpack that a little bit for us.
Yeah, this one is interesting to me because it, we've seen, all right, we're going to go to, we used to charge on a per seat basis, right? Everybody's frustrated with that because there's all these seats that are being unused, and, it doesn't have a results orientation. And there's like, okay, we're going to go to usage, right? So maybe it's a token basis. I think more and more we're seeing, a results orientation to pricing, where you could say, hey, this, let's say it's an agent, right? This agent is designed to do X activity. Let's say it's something to do with sales. We're actually going to, we're going to have a pricing model that's, almost looks like a commission, right? In terms of the value added in that action. The corollary that I have there is is in the kind of the maturation of the ad tech world, right? We used to have advertising where it was like, we didn't even have impressions. It was just like, we put your brand out there. See, it's there. Trust
Sponsors.
Us.
You're
right?
sponsored. Yeah.
Found its way down into like impressions, and then clicks, and then installs, and then eventually into like the value of the purchases in the application, right? And all of ad tech started to run on a performance basis that way. Right. And you still have the brand stuff, but so much more of the spend and the compensation in that industry became performance oriented. And I think, we're just going to, that's what we'll see here and what we're seeing now. And I encourage founders, if you have yet to try this out, try it. Right. And test out what your business looks like if you're charging not on a per seat basis, but on a results basis. If you're driving great results, you'll make more money.
Yeah, we actually have a local expert on this topic, Michael Hoy. He's from Pendo. I don't know if you guys are in that one or not, but Atlas, Run Atlas. I need to have him on the pod to talk about this. That's a good. I'll send him a note.
I think I'm talking to him later today, actually.
Well, there you go. Yeah,
I'll tell him you're going to call.
He's like Beetlejuice. You mentioned pricing, and he just pops up.
Right.
Well, it's Michael Hoy. Did you talk about pricing? Have you seen, so ChatGPT kind of had this moment where they thought they would build like this, customer service agent. And if a human would cost you $80K, they could charge $20K. Have you seen anyone price like on that kind of like we're a portion of a human that we're replacing kind of a model?
I think I've seen it. I strongly discourage it. Right. Because, we're just like, we're then just inviting the like AI is taking people's jobs conversation. Right. So let's talk about the result. What's the work that human being does? And then if we are then taking that human being and expanding their remit with a tool in their pocket, and the tool in their pocket is driving a portion of the results that this human being is then going to do, shift a bunch of their time to do other things. I think anytime we start, I get it, right? We all get it. If there's real human replacement, a natural, bit of math you can do on what would you pay a tool versus what you used to pay a human. But I just think it's inviting a bunch of, kind of the risk and the concern around AI, which isn't wrong. And, you know, an orientation around the results of workflow and action is a better way to think about it.
This is a little bit out of left field, so feel free to say pass. But one thing we do is founders come to us and share like an exciting new thing they're using, or they ask what everyone else is using. And we can see, because we're in 165 companies, we can see a pretty wide field. And then Robbie and I consume this stuff like crazy. So when you talk to your folks, what are you seeing? And I kind of think of these different kind of functional stacks, right? So you've got your go-to-marketing stack, your GTM stack, you've got your dev stack. You mentioned Cloud Code. And then I have a personal productivity stack that's just like my own like CEO kind of operator-y kind of thing. What are some of the things that come up when you have those conversations? Just kind of top of mind things that have come up.
Yeah, I would say. I mean, I'll walk. I feel like we ask founders a lot of questions. I feel like it's turnabout is fair play to ask us these questions, right? So like I'll talk to you about like the Front Porch conversation around it. And some of the things we've been using. I mean, our tech stack today. So we're on G Suite and use Google Workspace for a lot of our core calendaring and mail and stuff like that. Right. We invested in a purpose-built CRM called Affinity, which is purpose-built for venture capital firms and private equity.
Yeah. Someone needs to disrupt that thing.
Yeah, we're like,
everyone that uses it hates it.
I don't know how to throw it out there, man. We're debating whether to renew it, right? And but the workflow as it exists today is that we have a bunch of things that ingest into our CRM. We can create lists of investors, lists of funds, lists of companies. Those drive a lot of our meetings. And then we have always and forever saved everything into a Dropbox that's like quadruply backed up. And we basically have some kind of data that moves over from Affinity into Dropbox. And then we have a Chat GPT module that will sit through a connector on top of Dropbox and allow us to hit Dropbox if we want to ever query information of our own first party data set. Right. But like we're like perpetually debating the thing, like, do we still need Affinity? Right. It's kind of expensive, but it's also really useful. Right. So we're having that debate, right? Do we have the right setup with Dropbox and ChatGPT Teams and the connector? And is that going to work for us over the long term or not? Right. That's an open conversation. Anyway, I see other things amongst our portfolio companies, but I was just trying to offer like the things we're doing too, because I feel like turnabout's fair play.
Anything from the portfolio companies? You don't need to name them, but just anything that has come up.
I mean, it's just sitting alongside people who don't, I'll go back to Cloud Code. I mean, if you're going to pull it down, you pull up a terminal and you kind of start playing around. That's one thing. Sitting alongside somebody who has actually really become an expert in using it is unreal.
They could spin up multiple agents in parallel very quickly.
It's crazy, right? So just like go find those people and watch them, right? And we do a lot of like founder intros where it's like, hey, you should go like this person on your team should go talk to this person on your team, right? And they should just like spend 2 hours together and just like trade notes. That's the one that jumps off the page over the last couple of weeks. That won't surprise anybody, but that's what jumps off the page the last couple of weeks.
Do you think some of the late stage SaaS companies are at risk? So, I know we as a ecosystem really, at least I'm a big cheerleader for Pendo. I think Todd successfully navigated all this stuff, but not to pick on them, but do you think the bigger they are, the more risk there is? Or do you think that if they can there's ways to defend against it, even if you're as big as like a multi-$100 million Pendo or one of those types?
I think this is just, this is just my opinion, and I don't have any kind of special knowledge around Pendo, but outside looking in, I feel like it's a really interesting and exciting setup actually for them in this era because of what they offer. Do they have the ability to lead the way towards a lot of this performance and results-based pricing and product orientation? And in doing that, do they then become a much larger business?
Yeah, in a world where coding's easier, product management, the thinking about and having care for what you build actually becomes more important because you have to choose.
You are seeing a scenario, like you're seeing this kind of like, the breadth of roles is expanding because certain, you're getting the depth from an AI tool, right? So the product manager is kind of overseeing more code creation than ever before. They're going to run the roadmap. They're going to either do themselves or have somebody alongside them that's doing QA. I mean, I don't know. I think I would love to be sitting in any of those chairs thinking about what to do next there because the opportunities are significant, I think. So if you're one of the big guys, I mean, it just depends on how quickly the smaller verticals start to tick down your revenue. And then if you're Salesforce, like how, I mean, nobody's going to jump off of a system of record like Salesforce tomorrow, much less any of the big guys, but they've been open around how, margin and profit oriented they intend to be moving forward. So then, what are their next moves to lock up their existing customers and make sure that they're, just kind of retaining as much of a pricing advantage as they have, leveraging the scale that they have to retain those folks, and then doing enough to bring to pull AI tools through into Salesforce to kind of help those big companies say, check, we did it.
Yeah.
Sales team's using AI, right? It's through Salesforce, right? It's through whatever. But I think if you really dig in under the hood, you're going to start to see verticals where there's way more churn, because there's something more purpose built in the vertical starting to take share.
It's interesting because a lot of startups in that 5 to 10 million, they're looking at a HubSpot or Salesforce, and I think I've seen several of them replace it because they're looking at what they're paying and then the cost to build, and they look at the workflows that their team's using, and it's actually pretty small. It's basically like a lightweight. And the reporting in those systems has gotten so bad, everyone uses other stuff for that. So there's like a little death by 100 cuts here. So then they realize the workflow they're using is just like enter a lead, track where it is in the stage, and then and then if you actually map out the screens and the workflows you're using, you're like, wow, I didn't realize we actually. This is like 8 screens in a database.
Yeah. And there's all in Salesforce, there's like all these objects and tabs. Like, we used to go deep into all this stuff.
Chatter, remember that? Einstein used to have all that stuff. Yeah.
And I think what's interesting for founders who are building, let's say they're building a deeply vertical, CRM to start, right? That looking side to side at other features that are relevant for their vertical from other systems of record. Right. So from an ERP, from a people system, and ingesting some of those features too, such that they're not the CRM for XYZ vertical, but they're starting to be like the system of record for XYZ vertical, is interesting because it starts to get those customers thinking that they can cancel some of these other things that they may or may not have. And then if you can do that while also giving some AI features that give those teams efficiency, I think that's a pretty fun setup.
Last question. This is funny because we're fundraising and this one's never come up so much as it does now. And I think it's a symptom of this SaaS apocalypse kind of thing. But everyone would always ask the moat question, and you would answer, and they'd be like, okay. But now, people are like, well, we really want you to see like 4 or 5 competitive moats. So it's kind of funny. It's like, they want like moats stacked on moats kind of thing. What have you seen any interesting competitive moats without going into specific companies, or how do you guys think about competitive moats? Is that something you believe in, or do you feel like, sometimes I've had founders say, well, execution, going fast is a competitive moat, which is, I guess I don't think that's the spirit of, a lot of people want some old school investors want like some IP ring, right? Like you've got this holy patent that will protect you forever. I also, as an operator, I think that's a little foolish because people can go around patents in a million different ways these days. But how do you guys land on the whole moat topic?
Yeah, I think, we need to be able to articulate it. We need to believe in where the founders are saying that they're going to build a moat. We're accepting of, and I think sometimes it's foolish to say like at the seed stage, like you're not going to have a moat yet. You need to know how you're going to build it, right? Where you think it's going to be, have some evidence of where it's starting to emerge. But if you got a moat, it's going to be pretty. It's a creek. It's a creek. It's a creek, right?
Yeah.
Your point. Intellectual property. Data. We see a lot of interesting data plays where just the more data that you're ingesting, the more that you can become, the thing that helps create first party data for the customer that's theirs. I think is interesting. That's not new, but is more interesting these days with, the way that data can get, ingested and utilized. And then for us, it's just it's like the eval is the moat. And what we mean by that is we always want to talk to customers, right? Because you can tell when you talk to a customer whether I mean, going back to, is this a vitamin or a painkiller, right? I mean, it's back to that whole conversation. Like, is this really something that you would fight with your boss to make sure you still were able to have in your day-to-day life? Or are you like, it's fine, right?
There's 12 of them, and we picked this random one.
Yeah. A lot of the questions we ask, given the setup's vertical, is like, what is the really unique, nuanced, and detailed requirement that customers in this vertical have that you have unique knowledge about? And then we spent a lot of time talking about it, right? And you can kind of tell there how much of a vision around, kind of the purpose-built future of the platform there is. I think speed is less of go-to-market effectiveness is a moat, right? Because great go-to-market teams are hard to come by, right? So that is a moat. But I think speed in terms of like code creation and stuff is way less of a, it's people are moving faster than ever before. Don't hang your hat on that.
Well, thanks, Joe, for hopping on and talking about what's going on in the world of SaaS. Also, it's always refreshing to have an investor that very openly talks about how you guys operate. I think as a founder, I always appreciate it because I always, most in the old school VC, it was this very opaque, these weird things like, well, I didn't invest in you because I didn't think I could return the whole fund. I'm like, what does that mean? So I love talking to you guys because you always have rational answers that I can logically understand versus kind of some of the old school venture things that were kind of slung around back in the day.
Anytime. Yeah. We've all sat in both chairs. So anything we can do to kind of demystify the industry, we're going to try to do.
Appreciate it. Tell Nick and Joe I said, hey, and I'll see you at an event here soon.
Cool. Sounds good. Thanks, Scott.
Triangle Tweener Talks is hosted by Scott Wingo, presented and produced by Triangle Tweener Fund, with creative assets and design support from our friends at Walk West. That's it for today's episode. A big thank you to our guests, sponsors, and the team that makes this podcast possible. If you enjoyed this episode, don't forget to subscribe, leave a review, and share it with someone who loves the startup stories coming out of the Triangle. Thanks for listening. We will see you next time on Triangle Tweener Talks.